Washington moves closer to reshaping crypto markets as the Clarity Act advances through the U.S. Senate, with the Senate Banking Committee holding its markup and vote on the bill on May 14, 2026. Not a discussion draft, not a framework proposal, a committee vote. The most significant piece of crypto legislation in American history just cleared its most important Senate hurdle. You have probably been ignoring crypto regulation news for years. Most people do. The headlines are technical, the language is impenetrable, the process is slow. And every time a regulation story appears, the price moves and then moves back, and nothing seems to actually change. This time, something actually changed. For the last decade, the crypto industry in the United States operated in a regulatory gray zone that was not gray by accident. It was gray by conflict. Two federal agencies, the Securities and Exchange Commission and the Commodity Futures Trading Commission, both claimed authority over digital assets, and neither conceded ground to the other. The SEC maintained that the vast majority of tokens were securities under the Howey test, an investment of money in a common enterprise with the expectation of profits derived from the efforts of others. Every token that met that definition required SEC registration. Almost nothing was registered, so almost everything was technically illegal. The SEC used that position to regulate through enforcement, suing companies, shutting exchanges, and extracting settlements rather than writing clear rules anyone could follow. The CFTC argued that Bitcoin and Ether were commodities, like oil or wheat, and therefore within its jurisdiction. Neither agency conceded. The overlap between their respective claims created persistent ambiguity for the entire industry and persistent legal risk for every company, every exchange, and every developer building on blockchain. The Clarity Act draws clear jurisdictional lines, establishes structured registration pathways, and introduces a framework that treats digital assets as a regulated asset class with defined rules rather than an enforcement target. That last phrase is the most important thing written about this legislation. Not an enforcement target, a regulated asset class with defined rules. Under the Clarity Act, the CFTC would take a central role in regulating digital commodities and the intermediaries that trade or custody them. The bill defines digital commodities as blockchain-based assets that are not securities under federal law. This gives the CFTC explicit authority over spot markets for those assets, something it has lacked despite being widely viewed as the appropriate regulator for commodity-style trading. Bitcoin is a commodity. Ether is a commodity. The CFTC owns them. That is now the legal definition, not a court opinion, not an agency position, a law. The SEC does not disappear. It retains jurisdiction over primary market activities, token fundraising, issuance, and registration disclosures. If a company is raising money by selling tokens to investors, the SEC is still in the room. But the everyday trading of established digital assets on exchanges, the thing millions of people do every day, moves to the CFTC. The bill passed the House in July 2025 with a bipartisan vote of 294 to 134. That margin was not a partisan signal. It was a consensus signal. The Senate Banking Committee voted on it May 14, 2026. The next step is the full Senate floor vote, where at least 7 Democratic votes are needed for passage. Now here's the fight nobody is telling you about. The Clarity Act has one major unresolved battle that almost no coverage explains clearly. It is not between crypto and government. It is between crypto and banks. Banks that offer savings accounts are subject to deposit insurance requirements, capital requirements, and the full weight of federal banking regulation. A crypto platform that offers yield on stablecoins without those requirements is, from the banking industry's perspective, competing on an unlevel playing field. The banking industry is lobbying hard to restrict yield-bearing stablecoins, the products that allow crypto holders to earn 4 to 5% on their dollar-pegged assets. For Coinbase, Stablecoin-related revenue represented close to 20% of total revenue in the third quarter of 2025. Armstrong described the yield restriction as a provision designed to protect bank profits rather than consumers. A compromise emerged in May 2026, distinguishing between passive yields paid simply for holding a stablecoin, which are restricted, and activity-based incentives tied to trading, liquidity provision, or other on-chain services, which are permitted. Whether that compromise holds through the full Senate vote is the single most watched question in crypto legislation right now. Before the Clarity Act, operating a crypto exchange in the United States meant navigating overlapping jurisdiction claims from two agencies with different mandates and different definitions of the same assets. It meant that listing a token could expose an exchange to SEC enforcement action if the SEC later decided that token was a security. It meant that developers building DeFi protocols could not know whether their code made them a regulated entity. It meant that institutional investors with compliance departments and legal teams could not participate in markets that had no clear rules to comply with. After the Clarity Act, Bitcoin and Ether have a legal home. Exchanges that list them know which rulebook applies. Institutional investors with compliance requirements now have a framework to satisfy. JP Morgan analysts described Clarity Act's passage by mid-year as a positive catalyst for digital assets, citing regulatory clarity, institutional scaling, and tokenization growth as key drivers. Regulatory clarity does not guarantee price appreciation, but it removes the single largest barrier to institutional participation in crypto markets. Every pension fund, every endowment, every sovereign wealth fund that looked at Bitcoin and Ethereum and said, "We cannot participate without a clear regulatory framework," now has the framework. Whether they walk through the door is a different question. The congressional midterm elections represent a political inflection point. Supporters are aiming to pass a final bill before November 3rd, 2026. Midterm elections historically go against the sitting president's party. If Republicans lose the Senate majority in November 2026, the Clarity Act's political window closes. 6 months. The entire future of crypto regulation in the United States compressed into 6 months. That is the honest version of what is happening. Not that crypto just became legal. It was never illegal to hold. Not that prices will go up. Regulation does not guarantee returns. Not that this is a signal to buy everything. It is not. It is a signal that the rules of the game are finally being written down. And the people who understood the game before the rules were written down are now sitting at the table while the rules are being written. Whether you are one of them is still entirely up to you.